Hello viewers, welcome to my channel. In this video, I will talk more about the mutual funds. This video is grounded in my personal research and is intended solely for educational purposes rather than as investment advice. I trust that this video will enhance your understanding of mutual funds. You may have come across advertisements about a systematic investment plan on social media like YouTube and Instagram. For instance, if you invest rupees 2000 per month for 10 years, you could potentially accumulate rupees 34 lakhs. Have you ever wondered how mutual fund can generate 34 lakh in just 10 years with the monthly investment of rupees 2000? This means that an investment of 2.4 lakh over the entire period can result in 34 lakhs in next 10 years. Let's explore whether mutual funds have historically generated the significant returns by analyzing the benchmark returns in this video. Also, we will assess the sector performance returns over the last 10 years. Every mutual fund need a benchmark for effective performance comparison. Without a benchmark, performance returns cannot be measured. Here are the few examples of the benchmark. So for this mutual fund, Quant Mutual Fund, the benchmark index is Nifty 500, and for HSBC Small Cap, the benchmark is Nifty Small Cap 250, and few others has the benchmark of Nifty Large Mid Cap 250, and few has the Nifty 50 benchmark. For example, if we take the example of this fund, so your total amount invested via SIP is 1,20,000 and the returns were minus 16% because the mutual fund has given the returns of 1,16,000, and at the same time the Nifty Large Cap 250 benchmark has generated 1,15,715 and Nifty 50 has generated 1,19,261. This is for the year 1. But if you go to the year 3, the investment amount will be 3,60,000 and the Nifty Large Cap 250 has generated 4,56,904, which is greater than this mutual fund. So here the benchmark is outperformed than the fund. And if you look at here returns, the return is 13.12 for the mutual fund for the 3 years and the benchmark return is 16.22, and the same thing the Nifty 50 returns are 12.35. That means this mutual fund is overperformed compared with the Nifty 50, but again when it's compared with the Nifty large large mid cap 250, it is not performed well. So that means here the this benchmark has performed well. If this fund is performed beyond this number like 16.22, it means this mutual fund has performed well with compared with the benchmark. Now let's compare this since inception one. So this fund was incepted on 25th of February 1993 and total investment via SIP is 29 lakh 50,000. And total value as of 31st of March 2025 for this mutual fund is 3.7 crores with the annualized return of 17.25. And the benchmark value is 1.3 crores during the same time period, but the annualized return of 15.20, which is lower than the mutual fund. It means this mutual fund has performed well over this year. Now let's see the benchmark returns from past 15 years. These are the benchmark performance for over 15 years of data. And these six benchmarks are very famous in Indian stock market, especially in NSE. Nifty 100, Nifty 500, Nifty Large Mid Cap 250, Nifty Mid Cap 100, Mid Cap 150, and Small Cap 250. So every mutual fund should associate any of these benchmarks in India. This benchmark is also known as equity benchmark and it should be associated with only equity mutual funds. We start with Nifty 100. This data is from December 2005 to July 2025, which is equal to 19 years 6 months. So throughout this year, the lump sum investment has generated 12.2853% of annual returns, whereas SIP, Systematic Investment Plan, with investment of 5,000 on 5th of every month has generated 6.8147%, and daily SIP, daily means every day you are investing suppose 100 rupees in this benchmark, then it will generate 6.8155. Now let's say if we have invested 1 lakh rupee on December 2005, then end of the 31st of July 2025, the 1 lakh would be 9,71,157 rupees, and the investment of 5,000 every month SIP, that would generate 42 lakh 72,000, and daily SIP with investment of 100 rupees, and that would be generate of 26 lakh 9,663 rupees. The next one is Nifty 500 and it's generated 12.90% of returns from August 2005 to July 2025, close to 20 years of data. 12.9% is a lump sum investment and 7.26 is a SIP and 7.27 is a daily SIP. Let's assume if you have invested 1 lakh on August 2005, then the 1 lakh would be 11 lakhs 33,110 by end of July 31st, and 5,000 investment SIP investment, that would be generated as 48 lakhs 80,000, and daily investment of 100 rupees, that SIP investment of 100 rupees, that would generated 59 lakhs 49,000. Let's look at Nifty Large Midcap 250. It is more than 20 years of data. For one-time investment, it has fetched 14.72% of return, and SIP of 5,000 on 5th of every month it has fetched 8.41, and daily SIP is also fetched 8.41%. If we have invested 1 lakh on April 2005, and that 1 lakh value would be 16 lakhs 23,000 by end of 31st of July 2025, and SIP of 5,000 it fetch huge amount of 62 lakhs, and daily SIP of 100 it should have fetched 37 lakh 97,314 rupees. And now let's see the next equity benchmark, Nifty Midcap 100. It's from April 2010 to July 2025. One-time investment has generated 14.25% of returns, and while SIP and daily SIP has generated 9.98, which is close to the 10%, and the daily one is 9.72%. If you have invested 1 lakh rupees on April 2010, then it would have generated as 7 lakh 38,000, and SIP monthly SIP of 5,000 it would have generated 37 lakhs 51,000, and daily SIP of 23 lakh 4,000. And now let's see the other equity which falls under the mid cap, which is Nifty Mid Cap 150. So the data is from April 2010 to July 2025, and during this period the one-time investment has generated 14.086% annually, and SIP monthly SIP is 10.13 and daily SIP is 10.78. It means if you have invested 1 lakh on April 2010 in this benchmark, then it would have generated close to 9 lakhs, and monthly SIP of 5,000 it has generated close to 50 lakhs, and daily SIP of 100 rupees it would have generated 26 lakhs 11,000. And the last one is Nifty Small Cap 250. The data is from April 2007 to July 2025, and it has generated 12.87% of returns for one-time investment, and monthly SIP of 8.779% and daily SIP of 8.79%. So if you have invested 1 lakh in April 2007, then it would be 9 lakh 10,441 rupees, and monthly SIP of 5,000, it would have fetched 50 lakhs 85,000, and daily SIP of 100 rupees, it would have fetched 31 lakhs 18,000. The screen showcases the dynamic performance of equity benchmarks over a chosen time frame, vividly illustrating their total value and growth. Now let's check the sector performance from past 10 years. You can see the sector performance on the screen. Pharma, FMCG, IT, information technology, energy, auto, infra, banks, real estate, and metals. These all are sectors. Let's have a close look on the sector performance. Pharma was leading in 2015, 2020, and 2024. You can see that metal sector was on top in 2016, 2021, and 2022. Real estate was the highest one because it has generated 101% of returns in 2017, and 2019 it achieved 25.7%, and 2023 with 79.6%. Apart from that, we have information technology in 2018 and 2025 till 30th of June, banks were reported as 12.5% of returns. In this heat map, you can see that pharma, metals, real estate, information technology has attained the top position. The mutual fund can attain the more returns if they have invested in top three sectors in year by year. If they have invested, then the mutual fund will have a good returns and they can beat the benchmark returns. If they are not invested in these top three securities, top three sectors, then the benchmark will be outperformed compared to the mutual fund. We have looked at the returns of benchmark and sectors over the past 10 years. Do you think that investing 2000 each month can create a total of 34 lakh rupees in next 10 years? To get the 34 lakhs in next 10 years, it means the mutual fund has to generate 30% of returns annually. Achieving a 30% annual return from a mutual fund presents a significant challenge as no equity benchmarks have consistently achieved this level of performance. While the real estate sector has shown the potential for high returns, those gains have been inconsistent over time, and there is no assurance that such returns can be maintained in the long run. With the help of a heat map, we can see that real estate, metals, and infra sectors perform well over past 10 years. But if a mutual fund has invested more in these sectors over the past 10 years, then there would be a chance to beat the benchmark returns. Now let's take a look of the returns of thematic mutual funds over the past 10 years. A thematic mutual fund is a type of equity mutual fund that invests in stock of a companies focused on specific themes such as infrastructure, consumption, or innovation. Unlike sectoral funds which concentrate on a single industry, thematic funds can invest across multiple sectors that are connected by a common theme. For instance, a green energy thematic fund may invest in companies involved in solar power, wind energy, and electric vehicle manufacturing. The data presented indicates that thematic mutual funds have seen strong performance over the past decade. Notably, infrastructure funds have stood out, delivering impressive returns over a 10-year period. The Quant International Fund in particularly has achieved a remarkable annualized return of 21.66, highlighting its effectiveness in this sector. In summary, thematic mutual funds offer the potential for returns exceeding 20% annualized over a 10-year period, making them an excitement investment option. Meanwhile, non-thematic mutual fund can provide a returns in the range of 15 to 18% annualized over the same time frame. This indicates that both type of funds can be valuable component of diversified investment strategy depending on individual financial goals and risk tolerance. In conclusion, thematic mutual funds can potentially generate over 20% of returns over a 10-year period, while non-thematic mutual funds can yield return of 15 to 18% during the same time. These are the mutual fund that will have Nifty large mid cap 250 benchmark. This mutual fund will have Nifty small cap 250 benchmark, and this will have Nifty mid cap, and this will have large cap. Like large cap will have Nifty 100 benchmark, and value fund mutual funds, this will have Nifty 500 benchmark, and flexi cap mutual fund will have Nifty 500 benchmark. You might have come across a table showing mutual fund performance, but notice that it did not include benchmark returns. This can make it a bit tricky to see how well a mutual fund has done over the past 10 years. If you are looking at mutual funds, it could be really helpful to compare the returns with the benchmark returns. If the benchmark returns are lower than those of the mutual fund, then that's a great sign that mutual fund has done well. This wraps up the video. I'm confident that the insight on mutual funds I have shared will be valuable to you. Thank you for watching. Be sure to like and subscribe to my channel for more content.